Welcome to the InterMarket Analysis video update. This is a video that I do every week where we look at a couple of different main things. We look at the valuation of the S&P 500 on a historical basis and also on a forward-looking basis. Then, as the name of this video says, intermarket, we look at other markets inside of the stock market itself by looking at other indexes, other sectors, to compare them with each other and see how they're performing with each other. We also look outside of the stock market. We look at bonds, we look at commodities, because sometimes we can look at these different areas and get some insight or clues as to what's actually happening in the stock market in general, and breaking it down more to how is it interacting with the S&P 500, which is the foundation of all the analysis that I perform. This is being prepared for Monday, May 13th. The first area is S&P 500 valuation. We look at a thing called a PE ratio, price versus earnings, because it's ultimately earnings that drive stock prices either higher or lower. Looking back at historical earnings and then comparing it to price gives us different PE ratios. When we are at a PE ratio of 20 or above, the market is considered to be expensive. And that's where we're at right now. And we've been here for a number of years. Even during the whole COVID plunge, we just barely ended up going underneath the high PE ratio of 20, but we quickly came back above that. So this suggests that on a historical basis, stocks are expensive, but we don't really use this to make decisions. This is really just to give us an idea what is the overall valuation of the S&P 500. We can also compare that with other times in the market, going back to 1980, of events that have happened and what the valuations were at that time. There's another way of looking at this, and this is called the Shiller PE ratio, developed by a gentleman named Robert Shiller. And instead of just looking at earnings as they are released, this uses a more smoothed approach. It looks over 10 years to try to get things that are a little more on an average basis. Well, according to his calculation, as of Friday's close, we're at 34.18. We can look at a historical chart to give us some context. Also, we have a median and a mean measurement up here, and we're just a little bit under 16 and a little bit over 17 when we look at the mean and median. Comparing that to 34.18, yeah, this also confirms that on a historical basis, stocks are expensive, but it's been this way for quite a while. So it doesn't necessarily mean the market's going to fall apart. It's just giving us an insight as to the valuation of the S&P 500. Now, the market uses forward PE ratios, and I get this from Edward Yardeni's website, where this looks off into the future based on analyst projections and forecasts, which can change at any time. They may be realistic, they may be unrealistic, but it is what the market uses. The red line here is the current forward PE ratio for the S&P 500, and we're coming in a little bit above that 20 level at 20.3. Mid caps are more in the middle. They're fairly priced. They're coming in at 15.5, and a little bit under fairly priced are the small caps, and that's the green line that you see here. This has been going up as the market's been bouncing back up lately. When price goes up, the earnings ends up going down, and that makes this ratio even higher. And then we get to a point where maybe it gets too high and the market is due for some kind of a pullback. But we don't use this as a timing mechanism. We just want to know the state of the market overall. Another area that we look at is growth versus value. When the market is really doing well and going up, typically it's growth stocks that end up doing the best. When we're having some problems or the economy is really slowing down or the market is actually in a decline, that's when folks tend to prefer value stocks. And we compare both of those with each other. First of all, we look at what's called a peer growth index, all by itself. And this is in an uptrend. We see where the blue line is above the red line. We did fall down as stocks were under pressure in the latter part of April. We're coming right back up to the 50-day moving average, but we have not broken out above that moving average yet. We look at value, which is actually still doing a little bit better and is above its 50-day moving average, and it's also in an uptrend. Where we really get some insight is when we compare the two with each other. On top is a growth to value ratio. This is in a longer term uptrend, but we've been really chopping sideways for a lot of 2024, and we're not seeing any real upward thrust right now. On the bottom, this is an inverse where we look at value to growth, where this typically has been underperforming growth. Although it has been bouncing back lately, it's also been chopping sideways when looking at this ratio. The reason I have different charts is you can see there's a little bit of an offset here when we saw a moving average crossover. Sometimes we can get some insight by looking at an inverted version of that same chart that we wouldn't see by looking at a regular version of that chart. It all depends on what you see and what kind of insight you can get by looking at either shorter term charts, longer term charts. And so I try to mix them up. Here is a longer term chart. This is showing that same basic ratio, but using ETFs instead of indexes. And we're still seeing where growth has been outperforming value, and it's in an uptrend longer term. Here's the same ratio, but now looking at value to growth using ETFs, also showing in the with a longer term picture here that value is underperforming growth. And we look at those same peer growth indexes that I started off with. We do a longer view of those same indexes and showing that even though it's pulling back and we've been seeing growth underperforming, it is starting to bounce back up now. And the blue line is above the red line, so that means that the growth is in an uptrend when looking at a ratio compared to value. Then here's a shorter term look showing how value has been underperforming growth, but over the last session or two, it's been bouncing back up. Then we look at some other indexes and compare them with the S&P index itself. When this is going up, that means growth is outperforming. And that's what we're seeing, even though it has fallen down. But it's not really showing a lot of conviction right now. We've been chopping more or less sideways with this ratio. And we look at some other ETFs and take a longer term picture and use some different studies on here. This is called a rainbow, where when the market was really going down, and I've been really focusing on this in the daily videos, we came all the way down to this 250 period moving average, and we bounced up off of that. And so far, we came all the way back up to the top end of the rainbow. But over the last session or two, this has been coming back down. We haven't been able to break out. If we would get above this rainbow and keep going up, that would be more conviction that growth is outperforming value. There's an inverse of that same study showing how value has been underperforming growth, even though it came. And you see, this is another reason for showing different kinds of charts. It never made it up to its 250-day moving average with this rainbow, has been falling back, but over the last session or two has been outperforming. Then we look at small caps on an end of day chart and we compare growth to value that way. Sometimes we can get some insight there. We're not doing all that well. We're above the 200-day moving average with this ratio, but we've been chopping sideways the last few sessions. We want to see this really turn and go up for growth to be really outperforming. Also look at the mid caps. Also seeing some weakness here. We're below the 200-day moving average, and mid caps have been one of the stronger areas in the market. And we want to see this ratio really going back up if we're going to be more positive. Then the main one that I focus on is S&P growth of value, where we're showing a little bit of an improvement here. We got back above the 200-day moving average, but we want to see these ratios really going higher if we're going to be more positive. We also keep an eye on inflation, and we're going to get some big inflation reports in the upcoming week. We're going to get PPI and CPI coming out. On top here is a monthly chart of the CRB index, which has been chopping sideways. It was looking a lot more positive. Now it's starting to pull back. Now, this is a monthly chart, so it takes a while for this to actually play out, but this is still positive. On the bottom, we look at another ratio, inflation to deflation. When this is going down, that means inflation is underperforming or deflation is outperforming. We did start to tick back up a little bit, but lately we've been going sideways. We're also below the moving average. When we look at the CRB index, this is a daily chart here where it has been in a solid uptrend, but lately pulling back and coming back down to its 50-day moving average. And we look at the Baltic Dry Index, and some folks find this useful because this is what does it cost to ship products from point A to point B, specifically in the Baltics, this has been going up, and that can tend to be more inflationary. Now, there's folks that they'll take the S&P or some other index and they'll shift it forward by a certain amount and try to line up things. I don't do that. I just look at what is the Baltic Dry Index doing right now compared to what the S&P is doing right now. Some other markets that we keep an eye on, and this is really the only time each week that I look at these markets unless something really weird is happening. One market is the aluminum aluminum market, and that is now going in an uptrend. That could be somewhat inflationary. But when you look at food, corn is still in a downtrend. It did bounce back up to its 200-day moving average. We'll see if this breaks out and starts to turn over positive. Wheat also starting to break out, but still in a downtrend. This could also be inflationary. We look at fertilizer. Of course, that's needed by farmers to grow things, where over the last number of weeks, this is a 3-month chart here, where we have been seeing a gradual decline in the price of fertilizer. Oil, which really started to spike up as things were going crazy in Israel. Now it's starting to settle back down a bit, and we're getting a little bit under 80 currently, where we spiked up into the upper 80s there for a little while. We look at gas, which has been in an uptrend, but lately has been pulling back, which would be more welcome to most people that have to fill the tanks in their cars. This is diesel, which for the most part has been declining lately. That could be more friendly and deflationary. And heating oil has also been coming down. It's starting to look like it's in a downtrend now, as it's been falling back. Natural gas, which has been under a lot of pressure, it is bouncing back up, but it's still in a downtrend. Copper has really been performing well, and they call it Dr. Copper. Typically, when copper's doing well, that portends to a stronger economy going forward. When copper is under pressure or sick, that tends to mean that the economy, there, at least in the copper market, anticipating that the economy will be weaker. This is suggesting that the economy is going to be stronger going forward. We look at a copper to gold ratio. Gold's been all the rage these days, and people that have literally been waiting over a decade to see gold actually do something are like all excited and having parties right now. And for the most part, copper has been underperforming gold. When we see this ratio going down, that's what's happening. Copper's underperforming. But lately, gold's been hanging in there okay, but copper's been seeing a real surge up, and it's actually starting to outperform gold, but not enough yet to see a golden cross with this ratio. Here's a longer term chart where we have been declining overall for the last number of years, but we are seeing some bit of a breakout. This is the black area. And just to give some context, I plot the 2-year in green and the 10-year in red, where there's a really wide spread between these two right now. In a more normal environment, we would see them not get very far apart from each other, even though they're on different scales, and we would tend to see them moving in the same general direction. If this keeps going up and interest rates keep going up, that would be more of what we saw from about 2012 into 2016. We've been in a real different environment over the last few years since the COVID lockdowns. We'll see if something like that is just beginning, or is this going to go back to showing more of a wide spread? Here's gold, looking at it, and I just look at the ETF. I don't look at the futures contract and all that, so the numbers might be a little bit different. Where we are in an uptrend, we got up to 225 here with the gold ETF, and we've been pulling back since then, although over the last few sessions, gold has been bouncing back up. Silver has also been doing well in an uptrend, got up to a high reading, pulled back, and is starting to bounce back up. We look at the closing value for gold on the top, which has been going up pretty strong lately, and silver, which has also been doing well. And then we look at the correlation between the top chart gold and the middle chart silver. And when we get a high reading here, that means there's a strong correlation. Doesn't mean they're going up or down. It just means that gold and silver are going in the same direction at the same time. Then we have a gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And not right now, but we do plot a US dollar index here, but we're not really getting any insight from this. You can look down at the bottom, the correlation between the two. We're more neutral. We're not seeing a real strong positive correlation or any kind of a strong negative correlation. We're kind of in the middle. So this really isn't giving us all that much insight. Here's the dollar, which had been kind of strong. We're still in an uptrend on the daily chart, but lately we have been pulling back. And this tends to pressure stocks. When we have a strong dollar, stocks have a tendency to go down. The stock market likes a weaker dollar because when you're doing conversions and they're converting that, if the dollar is weaker, then they get more dollars to show in their accounting. And it's also more advantageous from an import-export basis if the dollar is weak. And so typically when the dollar is going down, that will help support stock prices. When it's going up, that can pressure stock prices. Here's looking back over the last 3 years where we were in a kind of a sideways trend, right? Or not sideways, a declining trend here. Finally, let's see, it was the end of March, we were able to break above this trend line, and we've been showing some improvement, even though kind of resorted to chopping sideways to slightly lower lately. We look at the euro, and then we compare it on top with the US dollar index on the bottom. And then I have the Japanese yen on top, the euro, and the US dollar. And I just kind of glance at these. I actually have breakout charts of each one of these that give us a little more insight. Here's the euro to the dollar, which is actually underperforming right now. The euro's been weaker than the dollar. It's been coming back up, but it's hitting resistance at both of these moving averages. If it breaks out above, that means that the euro will be doing stronger than the dollar. If it bounces back down, that probably means the dollar is doing better than the euro. There's the Japanese yen, and there's been a lot of this notice taking place of this bounce up in the Japanese yen compared to the dollar. But we've seen big bounces like this before. But when you look at this on a ratio basis, the Japanese yen is really underperforming the US dollar. Here's the British pound, which is also showing a bit of an improvement as the dollar's been under pressure, but the British pound is still in an uptrend compared to the dollar. Then we look at some different indexes, and I do show this in the daily video. We have the S&P 500, which is a weighted index. The bigger the company, the more impact it has on the S&P 500 and how it's calculated. Well, to look at it a little different way, there's an equal weight S&P 500 index, and that treats all stocks the same. That's the red line. The bar chart is the S&P regular weighted index, and they're both doing pretty good right now. One is not necessarily outperforming the other. We look at the equal weight and compare it with the S&P. Now, I have a chart that I show every day, but this is an inverse look at this. This is just showing when this is going down, that means the equal weight index is underperforming the S&P, meaning the big stocks are outperforming the smaller stocks. Well, we've been chopping around a lot in 2024. We're not seeing an awful lot of conviction. Yeah, a few little up moves and then down moves lately. You can take this as negative, meaning that, well, maybe the big stocks aren't as influential as they were. Okay, and they're pulling back, and ooh, maybe I better be concerned about that. Or you can look at it in a positive way and say, all right, yeah, the Magnificent Seven stocks, they've been doing well. Maybe they're taking a bit of a rest right now, but I'm more encouraged because I'm seeing more stocks starting to participate as the S&P has been going back up. So there's a positive way to look at this and a negative way to look at it. Then we do a ratio between the S&P 500 and the CRB index. This compares stocks with commodities, where they had come down to the 200-day moving average here with this ratio, and now bouncing back up and actually getting above the 50-day moving average. Here's an inverse of that same chart showing how commodities have been underperforming, but we saw a blip up in commodities. Now they're starting to come back down. Here's the NASDAQ 100 compared with the S&P 500. Now, the stocks in the NASDAQ 100 are also in the S&P 500, but there's more stocks in the S&P 500. And in a more solid environment, we want to see the NASDAQ 100 outperforming the S&P. That's not what we're seeing right now. It's still in an uptrend, but if we stay below these lines, we could see a death cross here with this ratio. In a more solid environment that really drives the indexes higher, we want to see this going up, which means the NASDAQ 100 is outperforming. That could change at any time. It's just lately we've been seeing the NASDAQ 100 actually not performing as strong as it has been and not assuming the leadership role that it has been assuming before. Now this is hanging in there a little bit better. This is the S&P 100, the biggest stocks in the S&P 500 compared with the rest of the S&P 500. And even though they're pulling back lately, it is showing that the S&P 100, the bigger stocks, are outperforming. Here's the NASDAQ compared to the S&P 500, also kind of chopping more sideways now. Now, both have been doing well, the NASDAQ and the S&P, but the NASDAQ is more tech-oriented, and in a more solid environment, we want to see this ratio going up. We're more or less going sideways now, but we still are in a longer-term uptrend. This is kind of the big one too that I've been noticing, the NASDAQ 100 compared to the NASDAQ. The NASDAQ 100, those are the big tech companies. You can see we're seeing a death cross with this ratio. Now that's negative in that maybe the NASDAQ 100 isn't assuming the leadership role that it had been. You could see this as positive, saying, well, that just means the rest of the NASDAQ is even doing better. So again, there's two ways to look at this. We look at the really big companies, the mega caps, and we compare it with the equal weight index. And you notice how before the mega caps were really outperforming. Now they're just kind of outperforming. We're still in an uptrend here, but we're not showing a lot of strength. Again, this could develop and change because we're getting close to all-time highs with the NASDAQ and the S&P 500. If we break to new all-time highs, we might see some of the big stocks really kick into gear. And June, July, and August tend to be good for tech companies, at least on a seasonal basis. Then we look at a ratio between the small caps and the S&P. This is going down. That means small caps are underperforming. Here's another way to look at this, also showing how small caps are underperforming as well. And that's a real disappointment to some folks. And if we're getting into an environment that's more friendly to small caps, because they have to borrow a lot of money, so interest rates really affect them. A lot of these companies are riskier. They're not as established. And sometimes folks they want to buy a stock at $1 and then sell it for $100 at some point. And that's the real intrigue of small cap stocks. And if this really goes up, that would give more support to the market. But the market's still been doing good anyway, even with the small caps underperforming, because it's the large caps and mega caps that have really been holding things together. And we look at the biggest software companies, and we're not seeing much of a bounce. We came down below the 200-day moving average and bounced up off of that, but we're not seeing any real strength here. If we continue to fall below these lines, eventually we might see a death cross with this particular trend. Here are the mega caps, and these are the ones that have really been doing well. We fell back in the latter part of April, but now we've been able to reclaim the 50-day moving average. And although they're not really breaking out at this point, they're still in a longer-term solid uptrend. The robotics and AI ETF, this is all the rage these days. It had been pulling back. Now it's starting to come up and peeking its head out of the rainbow. And it's doing okay when we can do a ratio between the robotics and AI ETF and the tech sector. But it would be even more positive if we could break out with this ratio and then see the rainbow start to turn back up. Dow Jones Composite Average. This takes the Dow, the transports, and the utilities together. Now, up until now, I've been saying most of the strength has really been coming from the Dow. The transports have been a real disappointment, and I'll show you that chart here in a moment. But the utilities have just really kicked into gear lately. So this upward move is, a lot of it has been the Dow, but now the utilities are starting to contribute to this. Then we look at the S&P 500 and we compare it with short-term bonds, 1 to 3 years. We're coming back above the rainbow. As we were under some pressure here, we were dropping down into the rainbow. The fact that this is going up is positive. Then we look at a broad market measure, the S&P 1500 with shorter-term bonds. We're also starting to come out of the rainbow there. Look at another broad measure, and we look at further out bonds, 3 to 7 years. This is also showing some improvement after it had been weaker. And a total U.S. stock ETF, which is 2,651 stocks. This is breaking out in an uptrend and it's above its 50-day moving average. Now, if we could get back to this previous all-time high and then break out some more above that, that would be more positive for the broad market. Low volatility stocks are in an uptrend when you look at them all by themselves. But when you compare them with the S&P, they are really underperforming right now. The tech sector, compared with 3 to 7-year bonds, just getting back up to the upper end of this rainbow. As stocks were under pressure in the latter part of April, this ratio was coming down. Now it is showing more improvement. Then we look at the S&P, and this is another chart that I show in each daily video. These are different advanced decline line studies across the different stock markets. On top is the NYSE common stock. Then we have the S&P mid caps and small caps, and they're all above their moving averages, and the moving averages are starting to turn up. We want to see small caps do better than they have been, but for right now, the index that I focus on, the S&P 500, it is looking fairly solid. And we look at Dow theory, where on top we have the Dow, which is coming close to back to its all-time high here. The transports have been a real disappointment. They're bouncing back up a little bit, but they have a long ways to go to get back to their all-time high. But look at utilities, man, just getting a fire and going up. Coming back, not quite to this previous high yet, but they've been really in favor lately. Now, this could be a little bit concerning. Usually when utilities are going up, that means the market could be turning more defensive, anticipating some difficulties coming in. We're also seeing that with staples that I'll show you later on. And this is what I've been pointing out in the daily videos. The transports have been a disappointment. Yeah, they're going back up, but we're not even back to these previous highs that were set in late 2023, let alone another high earlier in 2023, and the all-time high stepped back in 2021. To turn more positive, we want to see the transports really kick into gear. There's a joke in there somewhere, and really go up. Here's a ratio showing how the transports are really underperforming the S&P. We do another ratio between the Dow and the transports. When this is going up, which is what it's doing now, that means the Dow is outperforming the transports. And we do a relationship. We look at the S&P and the transports, and when this is pretty strong, like it is now, we're getting a pretty high reading. That means that there's a strong correlation between the two. If one's going up, the other one's probably going up. If one's going down, the other one's probably going down. And then this is a new adaptation of Dow theory, where instead of using the Dow, we use the S&P, and instead of using the transports, we use the NASDAQ. And we're not really seeing anything all that crazy right now. This red line is just back to the previous all-time high with the NASDAQ. When we're getting close to setting another new all-time high here. But we look for either positive divergences, which is a convergence, and that's kind of what's happening right now. If things were turning more negative, we would be seeing these two charts not really move in tandem with each other, but that's not happening currently. Then here's even a further breakdown and another idea behind Dow theory, where instead of using the S&P, why not use the equal weight S&P? And instead of using the NASDAQ, why not use an equal weight QQQs of the NASDAQ 100? And we're not really seeing anything all that out of the ordinary here for right now. We're just breaking out. We never did come back down to the previous all-time high for the S&P, where we did drop below the previous all-time high with the Qs. The FANG index, Facebook, Apple, Amazon, Netflix, Google, we're above the 50-day moving average. We've been chopping sideways over the last few sessions, but we are in a longer-term uptrend. And I just have this on here in case we start to see a lot of weakness. I'll be looking for areas of possible support. But since we really haven't been falling, at least lately, this chart hasn't been all that helpful. This is the Wilshire 5000. This is another broad market measure, also breaking back above its 50-day moving average and in a longer-term uptrend. ARK has just really been frustrating. It was all the rage there back in 2020, and a lot of people were getting into it. And then as things were going down and the stock market started to show a little bit more of a recovery, ARK just kept going down, down, down. And it has, shown some improvement here, and it's still in an uptrend, but we're dropping below both of the moving averages. The longer we stay below this, we might see a death cross with this ratio. Then we look at a monthly chart of the S&P 500, and we take a ratio of a global index of stocks that are in Europe, Australia, Asia, and the Far East. That produces this line that we see here, which continues to go, well, it's down lately, but it's still above this red line, which is a long-term moving average. As long as we're above this red line, that means that the stocks in the US are outperforming global stocks. And we do a momentum oscillator on here, which is actually turning down just a little bit. But this is a monthly chart, so it can take a long time for this to develop. Then we compare stocks with bonds. Here's the total bond ETF, which came all the way down to its 200-day moving average and has now been bouncing up. And this is bonds based on price. So as this is going up, that means interest rates are going down. Here's a world bond index, which has been very choppy. And we're getting close to a death cross here, but we're not quite there yet. The blue line is still barely above the red line. We want to see this be doing better on a world basis. And that means if price is going up, that means for the world, interest rates are coming down. We look at a monthly chart and compare stocks with bonds, showing that stocks continue to outperform, and they have been now for the last number of years. This is a daily chart of looking at that same thing, but it's comparing bonds with stocks, showing how bonds continue to underperform. Then we have high yield corporate bonds. You probably also know them as junk bonds. They're coming back and setting recent new all-time highs. And we look at corporate bonds, which have a ways to go to get back to their all-time highs, but they are in an uptrend. They came down to their 200-day moving average, and now they've been bouncing back up off of that as bond prices have been improving. Then we do a ratio between riskier bonds, meaning junk bonds, and more conservative bonds, meaning government bonds or even old stodgy conservative companies. And when this ratio is going up, that means folks are preferring riskier bonds. They're willing to assume more risk to get a higher yield. Instead of getting into safer bonds, they're willing to take that risk because the yield or the return is more important to them. And we look at a correlation between stocks and bonds, and this is bonds based on price. And they have a pretty strong correlated relationship. So if bonds are going up, stocks are going up. If bonds are going down, stocks are going down for right now. And we look at the corporate bond index, which has been chopping sideways lately, but it's still in a longer term uptrend. And here's just some Fibonacci studies on the 10-year yield. We're in between all these different points here, so we're not getting some insight. This is giving us some insight because for 40 years, we were seeing interest rates going down. Then we had the whole COVID plunge. Now we're starting to come up into a higher range, which would really be more normal. The last 40 years is what's abnormal. Unfortunately, there's one or two generations of money managers and investors who think this is what it's always going to be like when we could be shifting back to a higher interest rate environment. And that might cause a little bit of misplaced perception of what's going on. Here's also some Fibonacci lines with the 30-year yield. Again, we're in between any kind of measurements right now. This is looking at the S&P and then the yield of the 10-year, where the stocks had been underperforming, or the S&P had been, but now it's starting to bounce back up, but we're still coming up to the higher end of the 50-day moving average. It would be more positive if we see this ratio going up. That would be more positive for stocks. And this, I've been showing this a lot lately too. This is comparing 3 to 7 year bonds with stocks. When this is going down, that means bonds are underperforming. We were starting to see this spike back up, but lately it's now been coming back down. Junk bonds, they continue to do quite well and are recently setting all-time highs. Now, this is an ETF of junk bonds here. And we compare junk bonds with government bonds, and the junk bonds are outperforming. Not really surprising. Here's an ETF of the 7 to 10-year bond based on price, where we came back up to the 50-day moving average, and we bounced a bit down from that. We got back up to the 50-day moving average on Thursday, but fell below it on Friday. We're still above 50 with the RSI, but coming down, and the momentum is continuing to be positive. And here's a daily chart showing how interest rates had been going up for the most part, but over the last week or two, they've been coming down, and that's why we're seeing a nice little bounce in the stock market to this point. There's a weekly chart looking internationally with the US and UK having the highest rates, and German rates and Japanese rates, and all came down on this weekly chart. We look at the MOVE index on top, which measures the volatility of bonds, the VIX, which measures the volatility of stocks, and the correlation between the two is pretty strong. That means that it's not looking at price, it's looking at volatility. They're going down with their volatility, and that's a pretty strong relationship currently. And we have a monthly chart of the 30-year bond ETF, which has been in a downtrend for quite some time, since about the latter part of 2020. But then we do a ratio on the bottom comparing bonds with commodities, where bonds are still outperforming. But again, this is a long-term chart. And we look at different sectors. A number of months ago, I changed how I do this. I used to just show the ratios. Now we look at the sector itself, seeing that the materials are in an uptrend. Then on the next slide, we do a ratio of that sector with the S&P 500, showing that the materials, they've been bouncing back up lately, but they're still in a downtrend compared to the S&P. Communication is in an uptrend when you look at it by itself, also outperforming, but coming back down to its 50-day moving average with this ratio. We want to see this really going up if it's going to give more support to the market. Energy, which has been really strong, pulling back, fell under its 50-day moving average, lately has been bouncing back. And when we look at energy and compare it to the S&P, it has been really underperforming, starting to bounce back up. And it's still in a downtrend. The red line's above the blue line. And as energy's been under pressure lately, we've been seeing this ratio coming back down. Financial sector, which has been hanging in there pretty well. It's above its 50-day moving average and going higher. It's also doing pretty well compared to the S&P 500. Industrials also in an uptrend by themselves and doing a pretty good job of outperforming when compared to the S&P. The tech sector, back above its 50-day moving average, but not really breaking out when compared to the S&P 500. Since the beginning of March, this has been coming down. It's still in an uptrend, but this is the darling sector that everybody loves. And so we need to see this really going up if we're going to turn more positive. The fact that this is actually coming down, that's a little bit of a concern to us. Staple sector, another area that in a solid environment with interest rates going down and the Fed possibly cutting rates and things looking better, staples should be going down. They've been going up. They've been going up strong. And this is a more defensive area because these are things you have to have no matter what's happening economically. Think of toilet paper or toothpaste. You can't just buy those things when the economy's good. You need them even when the economy's bad. But when we compare it to the S&P, it is underperforming. And so that's been encouraging in and of itself. But we're seeing staples all by themselves, just really solid these days. In fact, you can see even this ratio is coming back up. Not enough to turn positive yet, though. Real estate, well, when you look at it by itself, it's in an uptrend, but as we were having some problems and interest rates were starting to go back up, we saw this coming down. Now that interest rates might be a little more friendly currently, this is bouncing up, but we cannot get above the 50-day moving average, at least yet. And the ratio between real estate and S&P shows how real estate's really underperforming. Utilities just going to the moon these days, even though they pulled back on Friday, but this is really breaking out. And this is another defensive measure. This is what folks get into when they're worried about what's going to happen in the stock market. We do a ratio, they're still underperforming, but you can see since the beginning of March how they've been really making a comeback here. And then we do a ratio between the S&P and utilities. When this is going up, that means the S&P is outperforming, and that tends to mean the S&P is going up. When this is going down the way it has been lately, that means utilities are outperforming, and that can put some pressure on the S&P. So we want to see this ratio turn and go back up to give more support to the S&P. Healthcare, again, another thing you have to have no matter what's going on economically. It is in a longer-term uptrend, saw some weakness, and trying to get back above its 50-day moving average. On a ratio basis, though, it's really underperforming. And this is another defensive type area. Discretionary, the things that make life fun, like McDonald's and Tesla and all those wonderful things that we can do. It's still in an uptrend, but it's been disappointing lately. And Tesla has really been dragging this thing down. It's actually still below its 50-day moving average. What's causing a concern is when we do a ratio. In 2023, the nice bounce that we were really seeing, a lot of that was coming from discretionary. Now it's continuing to underperform on a ratio basis and still going down. And this could at some point put some pressure on the market. Semiconductors, a real big area of tech, coming back up to its 50-day moving average and still in a longer term uptrend. Energy, which was really making a comeback a few months ago, now has been pulling back. It came down to its 50-day moving average with this ratio. If this keeps going up, we would see the blue line cross above the red line, meaning that energy would be outperforming tech. Growth compared to bonds, this continues to be in a more solid uptrend as growth stocks are outperforming the price of bonds. The tech sector compared with the 10-year yield, chopping kind of sideways, but the tech sector is outperforming, but seeing some weakness. We want to see this going back up to turn more positive. Here's an inverse of that same chart, how the yield had been underperforming the tech sector. Now it's bouncing back down. We want to see this continue to go down to turn more positive. And then discretionary to staples, this is where some of the strength was really coming from, as discretionary was outperforming staples. Now we're seeing a death cross here with this ratio as discretionary is underperforming. And here's the same look at this, staples to discretionary, showing how now staples are starting to outperform discretionary. And that's a bit of a concern and something that I've been bringing up in the daily videos. Gold is finally seeing a cross here, a golden cross when compared to the S&P 500, where it had been underperforming. Now, about the time it starts to outperform, that's when we see gold pull back. Isn't that always interesting? And gold is breaking out when compared to the dollar. We're seeing that on the weekly chart. We're also seeing it here on the daily chart. High leverage loans. This is one of the more positive areas that I've been focused on. Even through the downward moves that we've seen over the last couple of years, we have not broken below the 50-day moving average with this ETF. These are very risky loans. And the fact that this is holding up is more encouraging for the economy as a whole and for the market. NYSE Composite was able to get back above its 50-day moving average, a broad market measure. All stocks, another broad measure, is coming back above its 50-day moving average and coming really close to this recent all-time high. Emerging markets are showing some improvement here and are in an uptrend. The Japanese Nikkei, which finally broke its all-time high set back in 1989, fell back. It's not quite back up to that level yet, but it's given it the try. Microcaps, smaller stocks, still in a longer-term uptrend. And this line here, this is the 52-week low, which if we really start to fall, I'll have to readjust that. And then we look at the home builders, and we just are looking for mainly divergences here. We have the S&P on top, the home builders ETF. And when we're getting high readings, that just means the home builders and the S&P are going in the same direction at the same time. What we're looking for is when we get really low readings with this correlation, showing that they're going in opposite directions. And we haven't seen that in quite a while. Bitcoin, which went up to 73.8, has since been pulling back, but it's still in a longer-term uptrend. However, it has dropped below its 50-day moving average. Then we're looking internationally here, and we use the KST to measure this. Chinese stocks have been going up. Emerging markets are in an uptrend, Europe, Japan, and now the US. So we are seeing more of a global improvement. Here's an intermarket analysis chart where oil had been in the lead. It's actually dropping below the rise in gold going back to the beginning of 2024. In third place are stocks, and then the dollar and bonds based on price are still negative on the year. And we look at some correlations. We compare the S&P to the dollar, and they're going kind of in the opposite direction. So if the dollar's up, that can pressure stocks. If the dollar's down, that can give support to stocks. Also, we're seeing kind of an inverted relationship with S&P to oil, but it's not really solid right now. We're seeing it more with interest rates. This is the 10-year yield compared to the S&P. They're having a pretty strong tendency to go in opposite directions. And the tech sector to the 10-year yield, also opposite directions. And then the 2-year yield, also opposite directions compared to the S&P. Then we have some long-term charts that we look at. This is a monthly chart of the NYSE Composite. We're going up and we're above the red line. That's long-term positive. The momentum, as measured by the Copic curve, continues to be positive. Here's a daily chart. where we look at a thing called the NYSE record high percent index. After blipping down a little bit, this is now starting to go back up. And we look at the S&P on top. This is a monthly chart, and we're above the moving average. And even though we're rolling back over with the momentum oscillator here, we are starting to turn back up slightly. And here's a daily chart of the S&P on top, and then a ratio between stocks and commodities showing that stocks continue to outperform. Then another monthly chart of the S&P compared to another global index. When this is going up, that means US stocks are outperforming, and we're pretty much flat with this KST momentum oscillator. Then at the very end, I have those things that are positive. And for the sake of this video, my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. And this list is pretty long, and I tried to actually adjust it this week so you can see the whole thing. Growth and value looking alone, looking by themselves, are in an uptrend. Copper's in an uptrend, the British pound compared to the dollar, gold, silver, the dollar itself, the CRB index, the big software companies, but they're not showing as much strength as we would necessarily expect right now. The mega caps, the FANG index, ARC, even though it's been disappointing lately as well. The low volatility stocks by themselves, staples, the Dow Jones Composite Average, all of the different bond ETFs that we look at based on price. Now, the world bonds, they're in danger of turning negative, but they are hanging on, looking positive still. The tech sector and the semiconductors are in uptrends. High leverage loans, which is really holding up. The Dow, the NYSE, and Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps, all stocks, emerging markets, and Bitcoin. These are all in uptrends right now. Then we have a pretty short list of those things that are in downtrends. The Japanese yen to the US dollar and the euro to the US dollar. And that's it for the negative side right now. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. This is more of a supplemental video to go with the other videos that I post. I just break this out and do a separate video to make them so my videos aren't like 3 hours long all the time. So have a great weekend, and I will talk to you in the next video.